So let's begin, ladies and gentlemen. Our first speaker is the CEO and the Chartered Financial Planner of 8. He has over 25 years' experience in financial services and provides personalised expert guidance, helping clients achieve their financial goals. His leadership ensures that 8 delivers trusted, high-quality financial advice with precision and with care. So to tell us more about 8's vision and the strategy for long-term financial success, would you please give a very warm welcome to the CEO, Ian Riggs.
There we go. Thank you.
Thank you very much. Hi, everybody. Can you hear me okay? Good, good. It's fantastic to have you here in this amazing venue. I just got asked earlier on, how does it feel to be running an event like this, having been in this company for 25 years, and I can honestly tell you, very proud moment. I hope you're going to have a fantastic day, and we're going to give you some juicy little nuggets of things that you could or perhaps should be doing in your financial future with us. Now, we've got a mix of people in our audience today. We've got some existing clients who've been with us for a very short while, some long-standing clients who've unfortunately put up with me for more than 2 decades. We've got some new people interested and lots of our team. So I'm going to kick off just by giving you a little bit of insight into who are 8. And it's pretty straightforward. We are a firm of financial advisors delivering and offering one-to-one financial advice to our clients. We're operating currently throughout the UK and in Asia and the Middle East, looking after our expat community and very often working with that community in repatriating back to the UK. We have in excess of 15,000 clients, managing more than £3.6 billion of our clients' money. And we have a very important and fantastic strategic relationship with SJP, who I know a lot of you are very keen to hear from Justin today because, of course, they look after your money. Our job is to look after you. SJP's job is to look after your money. And I often get answered why we called 8. Well, 8 stands for exceeding our clients' expectations, for inspiring our clients to take action, for helping our clients grow their investments and ensuring that we continue to grow our client offering. Help is always on hand whenever our clients need it, and most importantly, for building long-standing, trusted relationships with our client throughout their journey. So exceed, inspire, grow, help, and trust. That is what drives our people in 8 every single day to deliver what we believe is a fantastic product to our clients. Our vision is very simple. Our vision is to deliver invaluable advice to bring your visions to life. Everything we're doing, everything we're going to talk to you about today is focused on achieving that vision, which is our clients sitting in the heart of that strategy and making sure that we help you achieve whatever you need. And I thought it would be smart today to tell you how we're going to do it. It's very easy to write a vision, but the most important thing is that you have a strategy that we can articulate both inside our company and, of course, to you, our clients. So our strategy of how we're going to achieve this is in 5 key pillars. The first thing we're going to focus on is empowering our advisors with knowledge, tools, support, and give them as much as we possibly can to ensure that they can deliver that one-to-one invaluable advice. And we're going to touch a little bit on today on some of those new skills and or tools that we're going to bring to our relationship with our clients. It's really important to have a team. Every great business has fantastic people behind it. So we're going to focus on developing our team into a team of high performers, focusing on delivering fantastic culture, a fantastic workplace, and making them enjoy their relationship with 8. And if we can deliver that, we hope that you will be able to feel that sense of community with our people moving forward. We must integrate technology in our business. We've got to focus on delivering seamless processes that do the administration, the processes as fast and as efficient and as accurate as we possibly can. And Carla is going to touch today on some of those developments that we've been working on inside 8 over the past few months and indeed years. We of course have to protect the business and protect our clients. Risk management, focusing on making sure that our business is doing the right things, our governance, our regulations, they are critical to ensuring that our clients are getting the right kind of advice at the right time. And of course that we're segueing our way through the ever-changing regulations that our industry provides us, as do our governments. As they change tax legislation and regulation, we need to be on hand to ensure we're fast and efficient in adapting what we do and delivering great outcomes for you. And finally, sitting behind all of that, we want to build a robust financial structure that enables this company to invest in its future, invest in its people, invest in its clients, and invest in our community to ensure that together we can deliver on our vision. So as a leadership team, we are absolutely focused clearly now on the one thing we need to do, which is bringing our clients' visions to life. And everything we do will be focused on these 5 pillars every single day. I talked before about the need to embrace technology. We must embrace technology, but that does not mean that we're going to turn into robots. We're not going to have robo-advice. Our product is one-to-one financial advice. Our job is to try and give you more access to more advice with people more often. But technology can empower people. And if we bring the right technology into our organization, we will be faster. We will have systems that are smarter. We'll give you access to things that are more convenient, more accurate, and safer. And we're going to talk a little bit today about some of the technology that we've brought in, as well as some of the technology that we are going to be bringing in moving forward, which I hope many of you will find interesting, and you have nothing to fear, because the technology that we're going to bring is going to be push-button technology. You just touch a button and it works. And most of the technology we're going to bring is going to be us bringing it to you. So how are we embracing technology at the moment? Well, we are currently partnering with some of the leading technology providers in the world. Our operating platform, which Carla is going to talk briefly about today, Monday.com, is one of the largest CRM used systems in the world. And Carla is going to talk to you a bit about how that has enabled us to drive efficiency and therefore really deliver faster, smarter outcomes for our clients. We are using it to train our people to maximize their time. And if we can get people in our teams using technology, it is going to drive efficiency. And of course, if we drive efficiency, we should be delivering and driving faster, smarter outcomes for you. We want to turn manual tasks into automated tasks. You know, when somebody says, I'd like something to happen, we want to have a process that just seamlessly enables that to happen as fast as possible with as little clunky, manual paperwork involved in that process. When our clients want to take money out, we do not want to be keeping them waiting for 6 to 8 weeks because of process and because of admin. Technology is what is going to enable us to deliver those faster, more accurate outcomes. And if we do the right technology with the right balance of risk, we can do it in a compliant way as well, which of course is incredibly important. We are going to enhance the way we communicate with you, our clients, using technology. Behind the scenes, there are systems and processes which we're using every single day, which are delivering things to you which just appear to be an invite to an event. But actually, what we're using behind the scenes is driving more engagement, and it's getting more people to come and listen to us and what advice we are going to offer those. And ultimately, we're doing all of this because we want our clients to have more time with their advisor to focus on you. If I loop back to 8, our vision is to bring our clients' visions to life. We're going to do this through one-to-one advice. We cannot have our advisors burdened with admin, regulation, and compliance. We need to unbundle and unpackage some of those constraints and give you more access to your advisor more often so we can help you whenever you need it. Some of the technology that we've already embraced is on the screen here. We use an internal communication system called Quill. Some of you in this room will be using Quill. It is effectively WhatsApp for work. So it is exactly the same as WhatsApp. Hands up if you don't know what WhatsApp is. Great start. Look at that. See, very tech-minded people here. This is the same process as WhatsApp. The difference, it's encrypted end-to-end communication. That means when you talk to us, it is a private and confidential one-to-one conversation with your advisor and our team, and it enables us to share documentation and information in an encrypted environment without the need for email. It can be on your phone, on your tablet, and accessed via the web. This will enhance the way we can talk to you. Most people use their phones more than any other product every single day. My wife told me at the weekend that we touch, she's a bit of a germaphobe, my wife. She won't forgive me for saying that, but she told me we touch our phone 2,700 times a day. 2,700 times a day. We need to communicate via this phone with you, not rely on our laptops and our email, maybe on our phone. Quill will bring that to you. We're also, a lot of you have got access to the SJP app, which gives you access to your investments and how they're performing. That app is going to be improved and enhanced throughout 2025, and it will include much more access to much more information on your investment products, on what are SJP doing with your money, and of course, ultimately, the performance of your investment with those. The two in the middle are new. What you'll see on the left-hand side is an application called Chickpea. And I suspect most of us would never have heard of Chickpea. In fact, about 3 months ago, I had never heard of Chickpea. But what Chickpea is going to do is focus on that idea that we want our advisors meeting with our clients and talking about them, not talking about stuff. We have a lot of regulatory things that we need to communicate with our clients. What Chickpea can do is take Ian Riggs, turn him into an avatar, enable me to record one time only what are our costs and charges, what is our risk strategy, the general stuff that we do as a team hundreds of times every single week. If we're having 10,000 interactions with clients a year and we're spending 15 minutes every single meeting talking about costs and charges, that is not a particularly efficient use of your time or ours. What Chickpea will do is it will bring that into one short video with your advisor before the meeting. And we're going to use Chickpea as a communication tool to our new and existing clients throughout the course of 2025. Very early stages in that, so don't expect too much too soon. But if you embrace it, you'll find what it'll do, it'll enable you to have that more access with your advisors, which is what we're striving to do. And the final one in the middle is a system called Voyant. Voyant is a new piece of technology that we brought into 8 very, very recently. Last week, we were performing lots of training with our existing advisor community, and it is our plan to roll Voyant out for everybody over the course of 2025. So what is Voyant? Well, it is a simple cash flow modeling tool. It is a bespoke piece of kit that will allow us to show each and every one of you your personal financial journey throughout the rest of your life. We can use this tool to plot your personal goals. We can do it to assess your financial strength. We can create bespoke timelines of when you want to retire, how much you want to spend in retirement, whether you want to make gifts to your children, how many gifts you can make. It can do absolutely anything we want. And what we're finding in our testing period is that Voyant is doing one significant thing, and it's encouraging our clients to spend their money. Yeah? This is a kit that can work out precisely, assuming you die at 100, precisely how much money you can spend every single year for the rest of your life, with certainty that you will not run out of money before you die. It is a tool that can enable you to calculate how much you can give to your family today through lump sum gifts or regular gifting. It can work out how much your investment portfolio needs to make net of all costs and charges. It can account for inflation. It can profile the risk of your portfolio that is required. And it can also help people as young as 20, 30, and 40 years old to build a proper, robust retirement plan that will enable them to get what they want. A simple question of when do you want to retire and how much do you want can be answered with the help of Voyant. And we're going to embed this into our offering throughout the course of 2025 and beyond. With the clients that we've used, and this is an idea of an actual client's timeline over the course of a 50-year period, this client fed back to us that they had an incredible meeting because of Voyant. They saw their financial future come to life, and they've now got confidence that they want to make their first ever investment into an asset allocation strategy outside of cash. It's given them the confidence to do it, profile the risk that they're going to take as a result of it, and driven the return that we need to make for them to enable them to deliver what they want. I had a meeting last Monday where we were introduced to a lovely lady who sadly had lost her husband in January to a very short and very sudden illness. And the lady, who we'd never met before, turned up to the meeting with her 21-year-old son, who's just finishing at Bristol University. It was very evident when we sat down that in the relationship between the husband and the wife, that the husband was very, very much in control of the financial world. She had no idea what they really had, but she wanted the answer to one simple question: can I stop work and spend the rest of my life with my children and my grandchildren? What we're going to do with her is gather all of the data for her. We're going to write to her providers, we're going to speak to her bank and to her pension companies. We're going to build a Voyant for this lady. Now, when you get particularly good at Voyant, that's something you can do live. And we managed to finish that meeting an hour and a half later with a very clear piece of advice to this lady, which is tomorrow you need to hand your notice in because you do not need to work again. She was in such a strong financial position that her son then became an interested party in the conversation. And I'm sure you can recognize that, because what he wanted to know, of course, was how much can I have? Mum, please, thank you very much. What we did is we plotted that out. You know, she's certainly not going to give him money at 21 years old, you know, at Bristol University, but maybe we should plot in 5 or 10 years' time that he might want £50,000 for a house. Is that okay? We can put it into this system. So we really can use this tool to give people what they want, give them the truth about what's possible, and enable and empower them to make very, very strategic decisions this year, next year, and every single year for the rest of their life. It's ready now. We're training all of our advisors. So your advisor may not be the advisor that delivers the Voyant session yet, but ultimately we already have a skilled team to sit down with every one of our clients on a one-to-one and show them what is possible. We're also going to focus on strengthening our communications to you. It's really, really important that we are talking to our clients more about what is going on, because there's a lot going on all the time. So we are going to be regularly updating you with communications via email. We're going to be providing more personalized phone calls and check-ins and meetings. We're going to be running more exclusive events and webinars to inform and educate you on what's going on. We're going to provide you with more information, stuff to read, access to guides, and all the time making sure that what we give you is safe, secure, and compliant. That's our promise to you. So what else is going on as I wind up, you'll be pleased to know? Well, we have our own Advisor Academy, which some of you may know about. It is incredibly important that if you're responsible for 15,000 people's financial well-being, that you make sure that they're going to have access to an advisor for the rest of their life. And a good financial advisor should be retiring at a reasonable point in time. Whether that's 55, 60, or 65, they're probably not going to be with most of you for the rest of your life if you achieve your 100-year objective, assuming that is your objective, of course. We need to make sure that there are advisors who look after you and your family for the rest of your life. The Academy is our way of doing that. And to put our Academy into perspective, there is 32,000 financial advisors in the UK. Less than 6% are under 30. Yeah, there is a problem. The advice gap, is coming. There's going to be a point in time, if we carry on the trajectory where we are, where there will not be enough financial advisors to look after the people that want the advice. 6% is too low. We're now running at about 15% of our advisors are under 30. There are only 174 financial advisors, less than 0.5%, that are under 25 years old. Why? Because we don't teach people how to be financial advisors. And I'm going to touch a bit on financial education in a minute. We have 6% of our advisors under the age of 25. There's only 16% of the industry that are female financial advisors. We are currently at 20% and climbing. And finally, this year, our plan is to put another 8 advisors through our academy. And our academy is focusing on a diverse and inclusive bunch where we guide them from experience. And what we mean by that is the knowledge of our most experienced advisors will be mentored down into our Aspiring Advisor Academy. We want to create the next generation with all the knowledge that our existing experienced advisors have. We're looking to do that with equal opportunities, and we are massively committed to making a significant change, both in terms of what we do and why we do it. And of course, I did knock on before to I mentioned before about financial education, which I am incredibly passionate about. I think at every opportunity I get, I talk about this. We do not offer financial education in schools. From the age of 5 all the way up until the age of 18 years old, we are not teaching our children in school what is a bank account, what is a credit card, what is a mortgage, what is a pension, what do you mean by tax? It doesn't exist. So we are taking the responsibility and we are providing financial education for any school, and I mean any school that wants it, whether that's a primary school, a secondary school or a college, or even a workplace. We have a program which has successfully delivered financial education into these areas throughout 2024. And we want to elevate that in 2025 and beyond. You'll be staggered at how many schools, when offered this free program for their children, say no. We get less than 5 out of every 100 schools say yes. That's a good look. Wide open mouth, shock. It's unbelievable how lacking we are in this country. So if you know, or you're involved in any schools or any colleges, or indeed if you work for a company, come and talk to us, because we're massively passionate about bringing financial education to the earliest age that is possible. Children become financially aware by the time they're 7 years old. By the time they're 7 years old, they have already become a spender or a saver. You will have children or grandchildren, and you've probably got, like most families, if you've got 2 children, there'll be a spender and there'll be a saver. And the reason the saver is following the spender is because the saver looks at the spender and decides, I don't want to be that. And vice versa. If you've got someone that saves, you've got the other child looking at their brother and saying, well, that's a bit boring. I don't want to be a saver. I'm just going to spend. But they make that decision by the time they're 7 with absolutely no idea as to the consequences that that's going to have on them as they become a young adult and into adult life and running a family. So we're here to help. We want you to get involved, and if you know anybody, then reach out and let us know. Finally, I mentioned last year about our impending change to simple, comparable charging. For 25 years, I've been working with a fantastic organization which has had less than simple, comparable charging. Good value, absolutely. Good advice, 100%. But it has not been simple or comparable, and it's happening. So with effect from the 27th of May, you will all be informed with very, very clear information what you are going to be paying for your product, precisely what that product is going to cost you. We will tell you precisely what you are paying for your fund management. So how much we're going to pay Justin and his team to manage your money. And we're going to tell you precisely what you're going to pay for the ongoing advice that we provide you on an ongoing basis. What that's going to do is enable you and anybody that's interested to compare what we offer to our peers. This is going to then be an industry standard offering. Anybody, anytime, anywhere will know what am I paying, for what, and what am I getting in return. Our focus is on the unbundling of our ongoing advice charge. The moment we tell you what you're paying us, we need to be very confident that when you see that, you think you're getting a good return on your investment. And that is why we're building a greater proposition for our clients moving forward and beyond in 2025. Finally, I just want to say thank you. Without clients, 8 is not a business. And without fantastic, interesting and engaging relationships, this business wouldn't be the business that it is today. So thank you very much for trusting us to look after you. Thank you for enabling us to look after your family and your well-being. We look forward to decades and decades more working with you. I hope you have an absolutely fantastic day today, and we look forward to welcoming you to more and more events moving forward. Thank you very much.
Ian, thank you very much. And the things I took away from that, well, obviously great work that's being done with the next generation in terms of making them financially aware. And I think we're all going to look out for Chickpea because it's such a memorable name. And we like the Voyant Financial Planner, which can open up a whole world of opportunities, obviously, find out what's possible and answer that lovely question, when can I retire? I'm going to sign up as soon as this is over. We are moving on now, ladies and gentlemen, to our next speaker who has over 15 years of experience in financial services. He specialises in later life lending and mortgage planning, helping clients and their families navigate home purchases, investments and refinancing with tailored long-term solutions. So to tell us a little bit more about introducing 8 mortgages and the tailored approach to strategic mortgage planning solutions, would you please give a very warm welcome to Gareth Davies. Hi, Gareth. Thank you.
Good morning, everyone. Can everyone hear me okay? Yeah, good. As I said, my name's Gareth Davies. I'm just going to take you through a few minutes and introduce 8 mortgages to you and let you know a bit more about what we do, how and why we do it. 8 mortgages is a relatively new concept or project for the 8 group, and it came to life after Ian and I had numerous conversations in 2023. We had worked with many mutual clients in the years leading up to that, and we sat down and kind of thought we need to make this a more official collaboration. And then, as a result, 8 Mortgages was born, if you like. And we built the mortgage brand, and we're building the mortgage brand with a clear goal and a clear vision. And that is essentially to bring mortgages into the heart of the 8 proposition and to help all of our people, all of our clients, all of our staff, client friends, with all of their borrowing needs. Unless you're very lucky, at some stage or other, you know, the likelihood is you will have had or have a mortgage. And so will your children and potentially grandchildren. And having advice, and that mortgage, would probably is probably going to be your biggest ever debt in reality. I would hope it probably is anyway. And that debt, for most people, protects or is secured against their most valuable asset. And for many, that's the family home. And so receiving advice throughout that home ownership journey is crucial. So who are we? So as I mentioned, my name's Gareth Davies. I've been working in mortgages since 2006. I started off in the subprime world, and then the 2008 crash came along, and it was a very steep learning curve for me into the world of mortgages and economics. In 2013, I set up my own mortgage brokerage, and along the years following that was when I developed relationships with people like Ian and a lot of the others here at 8 Wealth, and that's what's got us to where we are today. Alongside me, I have my colleague Alex, and Alex has been working with me in financial services since 2006. We actually started in the same company in 2006. Alex and I have actually been friends since we were at school, from 10 years old. So we've been working alongside each other and friends and close for a long, long time. And that it helps us in the working environment for sure. Alex left the mortgage industry for a few years, and I persuaded him to come back in 2017. And he's been working and advising alongside me ever since. In our Totton office, predominantly, we have Kelly. And Kelly is our client manager. She looks after pretty much everything. If I'm honest, she runs the show. She's not here today, so I can say that. But Kelly looks after the day-to-day running of the business, and she's absolutely invaluable to helping Alex and I speak to and help and visit as many clients as we possibly can. And she's been with me now since 2016, and she's an absolutely integral part of the team. So what do we do? Well, we help people get mortgage borrowing, but we look at all various areas of mortgage finance, but here in front of you is the top or the main 4 areas. Residential lending, so we help facilitate the mortgages for residential homes such that could be your first-time buyer, it could be your children or grandchildren buying their first property, it could be home movers, or it could be people just refinancing their existing homes. We also help with buy-to-let or property investment lending, and the buy-to-let area and property investment has become more difficult in recent years, and that's due to increased tax changes, government legislation changes, and there's actually a lot of proposed legislation changes due over the next 5 or 6 years, which people, for the most part, are completely unaware of. And it's vital now in this area of mortgage finance to receive advice. And we work alongside our 8 tax and accountancy service here to make sure that you're maximising both tax efficiency with property investment, but also your borrowing potentials. Later life lending. So what is later life lending? So later life lending, this is a sector which is probably the fastest growing sector of the mortgage industry at the moment. And for the most part, it's lending for people over the age of 55. And it can come across in various different forms, but one of those is what we call a lifetime mortgage or equity release. The words equity release used to strike fear into the heart of people, and because of the way it was done sort of 20 years ago. But the sector has gone through huge transformation due to improved regulations, product innovation, and it's now a really viable tool for people to use a mortgage into retirement, before retirement, to maximise either retirement income or just improve retirement lifestyles. And this is something that I'm very keen on, and this is something that I personally specialise in quite a lot. We can also cater for the more bespoke and unique scenarios, so whether that be bridging finance or development finance for a property build, that type of thing, commercial or semi-commercial finance, we can cater for all of those as well. Who do we help? The simple answer is as many people as we possibly can. We're here to help you, your family, your children, your grandchildren. We deal with many generations of different families. And to give you an example, last night, I had an appointment last night with 2 clients that have been working with me since 2008. And I've helped them purchase numerous properties in that time, get onto the investment ladder, and also refinance those properties at certain times. When I first met them in 2008, they had a young son. And he's obviously now grown, he's become a young man, and I'm fortunate enough to say that in the recent months, we've helped him, his fiancée, and their young son get their first family home. And I think that's testament to the quality of the advice and the service that we provide our clients, or you. That A, people come back and use us time and time again, but also that they're willing and happy for us and trust us to help their loved ones. Later life borrowers I've touched on, but gone are the days, essentially, where your mortgage has to be paid off by the age 65. It's not a thing. People are working longer, people are living longer, and now it's a viable tool to help improve retirement incomes or lifestyles. And people are looking at borrowing in later life for all manner of purposes, and there are more products available now than ever before. Being part of a St James's Place practice, we come across many people with funds under management. And that fund, those could be pensions, they could be bonds, they could be ISAs, etc. Unfortunately, many of the high street lenders out there struggle to understand how to use those funds to boost your borrowing power when it comes to a mortgage. Over the years, with our experience, and we've grown many relationships with lenders that can use these. So at any one time, we can look to use assets or funds under management to again boost your borrowing potential. And that could be whether you're in receipt of other income or not. And that's something that's very valuable for anyone associated with a St James's Place practice. Business owners and the self-employed, unfortunately, it is a little bit true that it can be more complex and difficult to obtain a mortgage if you are a business owner, a director of a company, or self-employed. And that's because the income setups vary. They're not the same as your standard employee. Again, working alongside us and a tax advisor, the tax and accountancy service, we're able to plan ahead and maximize both tax efficiency, but also keeping in mind any borrowing requirements that a business owner may have. So why consider us? I mean, the big thing for me is we're able to now offer holistic financial planning. Many of you are here today because you've got a great relationship with your financial advisor. And we're here to work alongside your existing financial advisor to reach your goal. So we work together with them to help you reach your goal. Whether that goal is to retire by a certain age, to be mortgage-free by a certain age, or to grow a property portfolio to provide an income in retirement. Having us and your advisor and all of the other areas of within the 8 group all working for you and with you towards that goal, it just makes sense. As Ian mentioned earlier on, technology is huge. And I was going to say I'm young, I'm probably not can't say that anymore, but technology is a big thing, and I'm a bit of a techie, and I love technology, and I embrace it to help us make not only the job easier, but the customer and client experience better. And one of those pieces of technology that we use in the mortgage team here is called the 8 Mortgage Monitor, and I want to kind of give you an insight into this today. What is the 8 Monitor? So this is a piece of technology which is transforming the way that people manage their mortgage. Gone are the days where you just deal with your mortgage once and you forget about it, and you speak to your advisor again in 5 years. People want to know more about what's happening with their mortgage over time. And this technology, it can do all manner of things, but some of the highlights, once you're involved with us and we monitor and we look after your mortgage, we enroll you into this mortgage monitor, and what it will do is it will continuously track the value of your property. So at any one time, you can log into the system to get an indication of what the value of your property is. Now, property values are very subjective. There's emotion involved with property. What it's worth to one person can be different to the next. But it will give you a very good indication of where you're at and what's happening in your region. And it does that automatically, and it will notify you on a fairly regular basis, not too often, so you don't get bombarded, of where you may be at. It will also allow you to continuously and regularly monitor the balance of any mortgage that you have and how it reduces over time. I wouldn't probably log in too often because mortgage balances don't reduce as quickly as we would all like them to, but it will give you a very good indication of where you are at in comparison to the value of your property. The one thing I like about it the most is it will track your mortgage for you and your mortgage product, and it will compare that product that you are on, or your child is on, or your grandchild is on, against the rest of the market, and it will compare that against the market 24 hours a day, 7 days a week. If at any point, whether you're a year into a 2-year fixed mortgage, 3 years into a 5-year fixed mortgage, if at any point there is a saving potentially to be made by switching your mortgage early, it will notify us, it will notify you, and we can then open those lines of communication to genuinely see how viable it is, to see if we can switch you onto that new product early to make a saving earlier than planned. And all of this is done automatically for you in the background, 24 hours a day, 7 days a week. Again, I'm going to ask you to get your phones out for those that want you to, but you can actually try the mortgage monitor yourself. You can scan the QR code on the screen and it will give you an idea of how that works, and you can use it moving forward. Now, many of you naturally won't have all of your mortgage information to hand, but if you have any questions about it, feel free to come and see me in the coffee break. So to summarize, we're here to embrace technology. We're here to help with many of you, your family, your children, your friends, as we possibly can. We want to take care of any of your borrowing needs, whether it be your first time or your last. And we're looking to look after generations of homeowners. Thank you.
We are going to start with our next session, which begins with our speaker, who is Carla Bishop, and Carla is the Head of Marketing and Operations at 8. Now, Carla drives business growth through innovation, through efficiency, and also collaboration. She is passionate about the culture and also service, and she empowers the teams to deliver operational excellence. The result is a seamless client experience without compromising on quality. So to tell us a little bit more about how she achieves that, would you please give a very warm welcome to Carla Bishop. Thanks, Carla. Welcome.
Thank you. Good afternoon. I just want to start off today by saying how grateful I am to speak to our clients today and be up in front of all of you. As Head of Marketing Operations, the majority of the time it's behind the scenes, so I don't get an opportunity to see all of our clients that we actually deal with quite a lot in the background. As Ian alluded to this morning, I'm going to talk to you about what goes on behind the scenes to make sure that your experience is the best that you can accept and expect from us at 8. So Ian talked earlier about our vision and how we bring clients' visions to life, and the 5 key pillars that we need to do to implement those and how we're going to achieve this. And the main one that I want to focus on today is the integration. Our marketing and operations that are working seamlessly day in and day out behind the scenes is all about the efficiencies to make sure that you and your advisor get the service and the business through as seamlessly as possible. Now, there's lots of challenges in our world, in operations especially, Regulation, heavily within the finance world. There's our challenges, there's efficiencies, the team, tech, but most importantly, it's you, our clients, and our advisors. We see our advisors in the marketing and operations world as our clients too. And it's ensuring that our staff, which is 100 strong behind every single advisor, has the passion and the knowledge of how we can deliver our ultimate goal, bringing our clients' visions to life. So I'm going to talk to you a little bit more today about what goes on in our world that actually will enable us to benefit you and want you to stay with 8 for generations to come. Challenges are a day-to-day. We like a challenge in operations world, and I certainly am very much of a solution finder, and we figure it out, and we move on, and we learn by challenges that hit us. There's lots of areas that affect us. Prime example is changes in markets, which we cannot control. Global economy, world events, consumer behavior and how people buy all affects your performance on a day-to-day basis. But in the background, we have to be ready, we have to be adaptable, and we have to know what we need to do in order to react quickly to what could potentially impact you and your advisors. We need to utilize the knowledge within our advisor world to relay that back to our team. We have people in our operations that are just starting out in their careers, that are 19, 20 years old, and we have people that have been in the business within 8 for 20 plus years. So we have to utilize and make sure that we are covering all of those areas day to day, that everyone has a consistent, streamlined approach and the knowledge in order to service you guys. Regulation is a key in financial world, and we are heavily regulated. That's to not just protect you as clients, but protect us and look after your investments with us. One of the major changes in the FCA, which Ian spoke about earlier, is the comparable charges. Now, we have to be business ready for this. And in May, we need to make sure that from the date of the 27th of May, our operations is working effectively and efficiently so that it does not impact you or the advisors. We are ready. We have multiple training sessions. We have lots of communication with SJP to make sure that all of the implementations and processes in the background, especially using technology, is ready to go. Now, we don't get this right all the time. Our government changes can impact us heavily sometimes, and then when the government and the FCA get together and they do things, we have to figure this out quick. Two of the areas that we dealt with last year that really impacted our operations was the school fees. So there were lots of parents out there impacted by potentially what was going to be a VAT impact on them, and what could that mean for their children and their future within their private schools. Our marketing teams had to get together. We had to make sure that we had the correct information, and we needed to organise an event and communications to get the message out to parents so they didn't need to worry and that they could speak to their advisors. The communications through the marketing team had to be robust, it had to be clear, and it had to be precise in what we needed the message to get out so that you could feel comfortable in those areas. The FCA changed the lifetime allowance last year, and it's now lump sum allowance, which we were not ready for, and we made mistakes. We needed a streamlined process. We did not anticipate the complexities of what needed to be written under the regulation in order to transfer to all of you as clients what that recommendation would be. And then on the top of that, the HMRC said to get your certificate, which is a simple application, which we did for you, would take 3 months. We weren't ready. We did not see or foresee that impact. By the use of our processes and technology, we have been able to learn what helps us move forward and actually foresee future predictions may come in. We know that there could be a problem in the HMRC again. What do we do? And the team in operations world ensure that the advisors do not need to worry about when they're having conversations with you, what this looks like. So regulation is it's a forefront of our business. We think about it all the time. But how do we ensure that you, when you have spoken to your advisor, get what you need in a timely manner so that clients can see their advisors more? Ian and Gareth both talked about technology, and the system that we've been using within 8 over the last 4 years now and building it gradually is Monday.com. This has enabled us to track your case from the moment you speak to your client right the way through to completion and long term. It enables us to see what staff skill sets we have so that we can utilize staff in the better areas that will benefit them and you. We can use this to look at trends. We can monitor capacity so that any time you speak to the advisor, there is a confidence within us that we can produce what you require. And it always boils back to the advisor can spend their time with you. AI is everywhere. We have AI chatbots in Monday that help us write formulas in the background, and they're quite, little quirky way. But what is coming within the system is the future's bright for this. It's crazy what the changes we're going to see over the next couple of years. We have, for example, a single task that has taken an individual at the moment 30 minutes to complete. And that is someone taking information from hundreds of pages of a document to one sheet. There is so much human error in that process over 30 minutes that we needed to find a solution. And it is finally here. With collaboration with Monday.com, we're going to be able to take that task away and be able to transfer that information from a document into a one-page summary sheet within 10 seconds. It takes away 30 minutes per staff per document, and we produce hundreds and hundreds of these every single month. What we can do, though, is utilize that time to skill set and build our staff's knowledge more. It enables us to then speak to you more. It enables your advisors to not worry about information being transferred, which is all liable for human error. The other area that we are looking at is how we relay updates and information to our advisor population. Our advice guidance pages are hundreds and hundreds of pages long, and they can change every single day. There could be a slight tweak in advice that means a paragraph within a 100-page document could change, and we wouldn't know. We now are going to be bringing in a system, and it's probably on the chickpea level of it's not here yet for everybody, but it will scan documents, highlight areas that have been updated, and then transfer that straight to the advisors with pinpoint areas of key guidance of advice that has changed that everybody needs to be aware of. We are building our technology internally. We're investing heavily in our people and training them to understand technology and how humans and technology can work together. We're very much a face-to-face business with our clients. We're very much face-to-face business with our team. We have people actively in the offices across the country every single day, and we're using that and utilising that to keep our team proactive and dedicated. So just to give you an example of our efficiencies, and this is one area we've looked at that we've been working on for quite a while. One task alone was taking 45 days from start to finish, liaising with different departments, talking to other people, and then manually putting a case or a pack together. We're now actually down to 10 days with the integration of Monday and the technology of the process with the little chatbots that we've got that are helping us streamline this efficiency. But it's given our staff more time to learn and understand what you, our clients, need. It's enabled us to grow our business by 30%, and that 30% isn't us then focusing on the new people, but it's enabling us to help your friends, your family, people you know, and it also enables us to be able to talk to you more. It's enabled us to recruit more people in our team. We now have a dedicated call team that's job, there's 5 of them, their job is to purely call you every single day, get you in front of your advisor every single 12 months, but also to talk to you if you need them. There are people there in the background that can talk to you if you need us. So we touched a bit about the team. We choose our team. We're very, very selective on who wants to join 8. And the main process for us to do that with our people is you have to be passionate, you have to be part of our family, and you have to want to learn and change with the times. Technology is huge. Anyone that's a bit tech savvy and wants to have a go at Monday, then we're all in. But they have to be able to adapt with the movement and shifts of 8. And we are very, very much on trend to make sure, ultimately, that we provide you with the best service that we can. Our team are dedicated, they're passionate about what we do. And it's all because of how we drive the culture of the business right the way through from our clients, our advisors, and to our team. So how does that make us, and who are we at 8? As I said, we're passionate and we're dedicated. My clients are our advisors and all of you, and we are here to make sure that you and our advisors have the best experience possible. We want to grow the business. We have people that are succession planning, and just like the Advisor Academy, we have people within our team that want to grow their careers within 8, and we encourage that. We put them on that journey, whether it be down the advice and advisor route, or whether it be internally into leadership and tech and training, or wherever they may want to be. But what does that mean for you? It provides you with a reliable, tailored service. It's a blend of technology and human interaction that we must get right every step of the way. We're grateful for the trust that you give us, and we're grateful that you're here today to see that what we actually can do and the amount of people that is sat behind you and your advisor. But ultimately, it's about the contact with you. We are here if you need us. And if the advisor's not available, the client executives are available. Our marketing team, as Ian mentioned earlier, are emailing you constantly. They want to hear back from you. The marketing team probably want to speak to more people than they normally do. But through email communication, we love the responses that we get back. And the responses over the last couple of years have been fantastic. So face-to-face advice isn't going anywhere. We are empowering our technology with our team and our human touch. And we want to say thank you for having the confidence in us and trusting us and the team sat behind the advisors for every step of the way. Thank you.
Carla, thank you very much. And it's great to hear about the amazing work that's going into making that client experience exceptional. Well, our final speaker today is Justin Onuekwusi, who is the Chief Investment Officer from St James's Place. Now, Justin has worked in investment management for more than 20 years. He leads St James's Place investment development team and also directs the investment proposition, asset allocation strategies, and the selection of external fund managers. As we said earlier today, it is quite rare to get him here in front of clients, so we are delighted he's able to join us. He's going to talk about market and political insights, smart investment strategies, and asset allocation. It sounds thrilling, doesn't it, ladies and gentlemen? Please give a very warm welcome to Justin. Welcome, Justin.
Thank you so much. So, 2024 was the year of the election. So, 50% of the globe went to the polls and voted. And the one theme that came out of 2024 was that voters voted for change. So, when you look across developed markets or the developed world, the incumbents either lost their seats or lost market share. So it's very clear that in 2025, and we've seen another election in 2025, which has gone exactly the same way in terms of Germany, but it's very clear in 2025 that 2025 has to be about policy and appeasing the voters that have voted for change. What does that mean? It means that from a market perspective, we're likely to see policies, first of all, that are out of the ordinary, that are different, that are trying to appease those voters that voted for change. From a market perspective, then, that is likely to mean that the market is going to be surprised. So you're going to see more extremes, both on the upside and the downside. So more extremes, more as what I call fat tails. So my name is Justin Onuekwusi. I'm the Chief Investment Officer at St James's Place, and I'm going to talk to you a little bit about these fat tails and what we are doing within our portfolios to guard against those fat tails. But before that, I'll talk a little bit about the market backdrop. Obviously, have to talk about the policies that are driving those fat tails, and we'll go from there. I think there's a couple of things that are just really important to stress. We are in a new political paradigm where global post-war institutions are going to be challenged. WTO, whether it's the EU, whether it's the World Bank, whether it's the UN, those global institutions are going to be challenged. And I suppose more and more, as we saw over the last few weeks, this political policy making is going to be done in the eyes of the public, on social media, and from a PR perspective, publicly. I think really, really, really important. So, just in terms of market backdrop, I'll talk very briefly about this. The key thing for when you look at these bars is that the best performing asset class, typically over the next 10 years, tends to be not the best performing asset class, and usually towards the bottom end of the spectrum. So you can look at here, you see US equities, and I'll come on to talk a bit more about US equities a bit later on. So US shares, you see over the last 5 years, dominating performance in terms of 5-year performance. But actually you see year to date, you see Europe, you see the UK, even emerging markets doing to US markets overall. On the left-hand side, you see the bonds, and really importantly, bonds haven't done that well over the last 5 years, but we think, given the current yields on bonds, given the market backdrop, that bonds are starting to look more interested. And if you have more extremes and you want to guard yourself against extremes, being diversified and thinking about your bonds in your portfolio are just really, really important. But really importantly, if you invest in bonds, don't just invest in one particular region. You have to spread your risk across the board, outside of the UK, into US, into Europe, into global bonds, because ultimately you don't want to be captive to political noise in one particular country. Spreading the risk over different bond markets, we think, makes a lot of sense. But key message here, best performing asset class has been US equities. The likelihood, if you look back in history, of that same asset class performing well for the next 10 years is actually very rare. And there's a reason why we think US equities are becoming more challenged, and it isn't surprise about the political scene on what's happening at the moment. Actually, it's about the dynamics of the market. So very briefly, I said we'll talk about asset allocation, but first I'll talk about manager selection. So what we do as a team, I have a team of manager selectors that go across the world and try and find the best managers in each asset class. Given our scale, 200 billion or almost 200 billion in assets, it means that we're able to uncover managers in places that simply other UK wealth managers simply cannot find. Because of the scale, because of the 200 billion, it means we can uncover those managers right across the world. And you see 40, or it's almost 50 fund houses now, but spread right across the world in areas, in geographies, right across the world. But importantly, finding the best managers is only part of the puzzle. And this is what this patchwork quilt tries to do. It probably takes a bit of explaining, so I'll try and explain it. So what this is simply 10 different asset classes year on year, and it just shows how the different asset classes have performed. It only shows 10, right? But actually, we could have 50 on here, but it'd be too complicated. So we've got 10 asset classes, and we've simply got how the asset classes have performed year on year, going back to 2026. And you see that you've got different asset classes that are number one, and so on and so forth, and bottom over time. So the first point is what fat tails mean is that the range between the top and the bottom performer we think in 2025 is going to be a lot larger. So actually you will get some really good performance, but also you're going to get some poor performance of certain asset classes over 2025. So more fat tails. I'll talk about how to navigate that in a second. But importantly, what we try to do, as I say, from a manager selection perspective, is in each of these boxes is to try and find the best manager in each of these boxes, right? That try and find the best manager who are managing these asset classes in the best way. But really importantly, it's not just about finding the best manager in each box. It's actually what box you're in the first place. The asset allocation. So how are we deciding what is our views on which box to be in before we even select the manager? And this is what we've done over the last 18 months, over the last 2 years, is build out, I think, a world-class asset allocation process. And really, really important, particularly in a world of fat tails, that you understand and you can tilt the portfolios, you can tilt your overall views into the right boxes here. So the asset allocation decision, which box you're in, far outweighs the manager selection decision in a fat tail environment. So how do we decide which asset class to go in? How do we decide which box to go in? So firstly, the key indicator to assessing which asset class is going to perform over the next 3 to 5 years is valuations. So how cheap is the asset class? So blank sheet of paper will tilt the portfolios towards cheaper asset classes. But really important, you have to try and understand why the asset class is cheap. And here we look at 4 key things, or 4 moderators. Fundamentals, which is the growth, the earnings growth, or any trends that are happening in markets at a particular point in time. Behavior is really important, and understanding market behavior, market sentiment, market positioning, because that can drive very short-term moves. The economic environment, which I'll come on to a bit later on. So where we are in the economic cycle, whether we are close to recession or we're in a growth environment. And then finally, tail risks. And I do think in this environment that actually tail risks are really important to be aware of. And these are things which can just derail your asset allocation. So it might be a big geopolitical risk, it might be a credit crisis, and so on and so forth. So being on top of those tail risks, I think, become really important, again, in a fat tail environment. So what does this all mean? So it means we get this kind of asset allocation view. So really importantly, if you have any, and I imagine that a lot of you do have portfolios with us, there are 6 key factors to think about which drive your overall return. 6 big factors. First of all, how much equities you have. Secondly, how much bonds you have. Thirdly, how much credit risk you see there. So what does this mean? How much high-risk bonds you have. Fourthly, how much emerging markets you have. Fifthly, how much sterling, how much pounds you have in your portfolio. And last but not least, how much inflation protection you have. So over the last 2 years, we've formed clear views on these big risks which impact portfolios. And this has become the SJP house view, so to speak. And at the moment, you can see we're neutral on a number of these, but the 2 key ones we're positive on is emerging market risk. And you might think, well, does that make sense given what's happening with China and tariffs and so on and so forth? I'll come back to that. And the other one is then sterling risk. Pound sterling looks quite cheap. So therefore, in our portfolios, we're tilting the portfolios towards sterling-denominated assets, so pound-denominated assets, because sterling looks cheap relative to that. As we get more granular, and these risks matter less, but I think the important thing as you get more granular is that you see that we've got a negative on US equities at the moment, and a positive on Europe, Japan, UK in particular, which looks really attractive, smaller companies, which looks really attractive. But ultimately, we do believe that the dynamics in the US market mean that the performance that you've seen over the last 5, 10 years is unlikely to be delivered again for the next 10 years. Happy to take questions on that, but there's an important dynamic which I will touch on with the US market. I mentioned the economy is really important, right? So the economy is a key moderator to us forming those views that you see on the left-hand side. So really importantly, you'll see this wheel at the bottom, and this just really tries to articulate what the economic cycle looks like. And let me explain. You can split the economic cycle into 4 key phases: early cycle, mid-cycle, late cycle, and recession. So very simply, 4 key stages. The best time to invest in equities or risky assets, the top line that you see on the house view, is when you are early cycle and you're coming out of recession, everything's beaten up. That's when you get your double-digit, really strong double-digit returns for the equity market. The second best time to invest is actually late cycle. So whilst late cycle can be quite volatile, it can last anything from 2 to 7 years, it can be quite volatile, it's actually a pretty good time to invest in equity markets. And we believe we're in a late cycle dynamic now where volatility is going to be elevated. So you're going to see more fat tails, as I say, both on the upside and the downside. Yet returns should be, based on earnings, based on what we're seeing in terms of growth, actually returns should be pretty attractive overall if there is not a significant economic shock. And I did mention that we may see at least some tail risks. So really importantly, then when we think about where we are from an economic perspective, we believe that 60% of our core view is that we're going to see a soft landing, which is like fall in inflation and positive growth. And we've got a 60% chance of that occurring. Only a 15% chance of recession. You might think, 15%, that's quite high. But actually, in any year when you look back in history, there's an 18% chance of recession, so 1 in 6 chance of recession. So actually, we're saying that based on where we are in terms of economic growth at the moment, which is looking quite healthy, that actually the chances of recession are lower than average. And then we've got a 25% probability into a re-acceleration driven by either too aggressive tax cuts, which will lead to, at least in the short term, a really strong boost for economic growth overall. But you can see overall 85% of our scenarios are actually positive, which you may think, looking at the news, how can this be? I'll touch on US equities and I'll come on to kind of how can this be a bit later. So I think I showed this last year, but what this shows is the S&P 500. It shows the top 10 stocks. I think you could ignore the yellow line and just focus on the orange bar. Just focus on the orange bar. So what this shows is the top 10 stocks in the S&P 500, so a 500 stock index. And you can see that in 2014, the top 10 stocks were around about kind of 5% of the total size of the S&P 500. Today, those top 10 stocks, the largest 10 stocks in a 500 stock index, are 30%. So top 10 stocks have gone from being under 10% to over 30% of the overall US equity market, right? So the stock concentration, the size of company, has become more concentrated in fewer hands. So we can debate whether US equities are going to outperform or underperform, but it's very difficult to argue, really difficult to argue, that today they're not more risky than they were 10 years ago. And if your attitude to risk hasn't changed, then ultimately, overall, you should be holding a lower amount of US equities overall because they're more risky. Really, really, really important. This isn't necessarily an argument about return, it's an argument about risk and how much risk you're willing to take to achieve the same return. Okay, so fat tails. One of the clearly big challenges that we have is that we do have these new governments in place, and it's always easy to focus on the US and Donald Trump. But actually, you are seeing policy across the world which is trying to appease to the voters that have voted for change. In terms of the US, I think there are three big things that we just need to think about and consider that could impact economic growth. The first one is tariffs. So post-war, essentially, the WTO has, over time, pushed down the cost of trading internationally between different countries. So for the first time post-war, that is under threat. And you've seen yesterday the tariffs that the US have put on Canada and Mexico have been implemented. So 25% tariffs on Canada and Mexico, and then there's additional tariffs on China of 20%. The big challenge with tariffs is then the countries who the tariffs have been imposed on tend to retaliate. So you tend to have then this tit for tat of the cost of goods going up. What does that mean? So in the short term, it means that from an inflationary impact, the inflation number will go up. That will go up because the basket of goods is getting more expensive. Longer term, and this is debated by economists all across the world about what's the long-term impact of tariffs. But the long-term impact of tariffs tends to be, it means that because goods are more expensive, you can afford less of them, and therefore growth starts to suffer over the longer term. So short-term inflationary, long-term growth negative. And it's really difficult to try and assess what the retaliation of these tariffs are going to be. Also, it's also difficult to know how long they're going to remain. So, and this is one thing that the president can act upon without he can do executive orders, so he doesn't need the Senate and the House to support him in that. And you're seeing that they're being used as a bargaining tool to try and get what the US want in the global economy. I think one aspect is that Trump looks at the deficit that the US has with other countries, a trade deficit. So when the US are buying more goods from those countries and saying he wants to try and impact that. So you saw in his first term, by imposing tariffs, it meant the trade deficit, so how much goods the US bought from China, went down. But ultimately what happened is those goods got rerouted to other countries and therefore came in different ways. So that's really, really important to recognize. So tariffs is the first one. The second one is he's clearly making big political changes, big senior hires in things like, the military and so on and so forth, and making those changes. But really importantly, with the big institutions such as the Supreme Court and the Federal Reserve, actually the president, they clearly nominate people when someone in the Supreme Court dies or the term for Powell finishes, but they cannot just remove somebody from those offices. So again, really, really important. The Federal Reserve has independence, and although Trump can publicly shame the chair of the Federal Reserve, that actually the pride that the Federal Reserve has in independence is really important for global markets to function. And I suppose last but not least is the geopolitics, and we saw that play out with Zelensky and Trump on Friday. I think a big challenge here is what's the impacts on markets of the geopolitics. And what you tend to find with geopolitics in general is you tend to find a short-term reaction, and then the markets ultimately tend to focus on fundamentals like earnings growth of companies. That's what drives equity markets. So again, really important to look through some of that short-term noise, look through some of the rhetoric, and focus on the fundamentals overall. That said, I did say that we're going to see more fat tails. Let me try and explain what this means. So typically, you think about the average performance of equities, for example. Let's look at, imagine this is the UK equity market, and the average performance of UK equities is that dotted line in the middle. Let's say it's like 7%. So typically, the extremes of one side of the average or another are that turquoise dome, so to speak. What we're saying is because you're going to see more policies, more extreme policies, that actually you're going to have more extremes, so that the orange dome, you're going to have more extremes at both the upside and the downside. So importantly, you're going to see, or you're likely to see, more volatility. What can you do in portfolios to navigate that? Well, firstly, I mentioned from an asset allocation perspective, we try to seek out cheap asset classes. And actually, what you tend to find in extremes, you tend to find you get more things in that left-hand tail that look very cheap, look very attractive. So actually, holding back and looking out for those opportunities are really important. The second thing you simply have to do is diversify your portfolio. Spread your risk over a number of different asset classes to try and smooth out, have less in those fat tails, or when the fat tails occur, have less in asset classes which are going to incur those fat tails. So diversification, spreading your risk over different asset classes is really key in this environment. I mentioned that emerging markets, you probably can't see this at all, but what it does show is it shows US equity markets, European equity markets, UK, Japan, and China in Trump's first term, so 2016 to 2020, so Trump 1.0, so to speak. And what you can see is actually, despite tariffs being put on China, which was significant in Trump's first term, that actually the Chinese equity market actually delivered pretty similar returns to the US equity market over that time horizon. So it's really important to recognize and not just focus on policies, but understand the wider dynamic. So what happened there is that China stimulated their economy significantly, and that led to Chinese liquidity and actually pretty strong returns for the Chinese equity market in Trump 1.0. So all things aren't what they necessarily seem. I mentioned the importance of diversification, and I mentioned the importance of bonds. So bonds are a key diversifier relative to the more volatile equity markets. So you saw that over the last 5 years, bonds simply haven't done that well. They haven't done that well relative to equities. But when we go back to 2021 and we show equities, which is the turquoise bar, so these are, you're mainly driven by US equities, but UK, Europe, Japan, there's global equities here, the turquoise bar. And we show the orange bar, which is bonds. And then we show when you see those big drawdowns in the equity market in 2001, in 2002, in 2008, 2011, when you see those big drawdowns in the equity market, when you see those negative fat tails, what's the asset class? Or bonds have provided positive returns in those environments. So if there is a growth scare, if there is a challenge around negative fat tails on the equity market, bonds help to provide that protection relative to those negative markets. The only time you haven't seen that in the past 25 years was 2022, where you saw a sizable inflation scare. The last thing I wanted to touch on is where are the opportunities? And I mentioned about small caps. Small caps look very attractive relative to large cap stocks. The format has gone a bit awry, I see on the table there on the right-hand side. But what does this show? On the left-hand side, this simply shows the performance over time of small caps versus large caps. So the line you see in the middle shows that small caps typically outperform large caps by, so smaller companies tend to outperform larger companies by around about 2 to 4% every year. Yeah? And you can see that there's more green bars on there than red bars. So typically, smaller companies, again, tend to outperform large companies. However, what you've seen over the last 10 years is that smaller companies have significantly underperformed. So they're in that red, the red highlighted bar there. They've underperformed by between 2 and 4%. And this is despite earnings growth being stronger for smaller companies versus large companies. So this is an example of something in that left-hand fat tail that we're tilting the portfolios towards, because the earnings growth is there, they're cheap, they're unloved by many asset allocators, many investors across the world. And also, from a manager perspective, when we've done research for managers across the world, we are getting fees from these managers that I simply haven't seen in my lifetime in terms of what small cap managers are charging us in terms of it being low. So really, really important. We've got, I suppose, lots of things in favour of small caps, and we do think this is an area which will do pretty well over time. What else matters? I mentioned geopolitics in the short term. The one thing to keep an eye on is credit conditions. So this is how banks and companies are lending to each other. It's very benign at the moment, looks very good. So ultimately, that seems to be a tailwind for growth. US growth at 3%, global growth at just below that. So you've got pretty good global growth overall, but it's really important to keep an eye on the credit crunch, on credit conditions, and keep an eye on the politics overall. And I thought I'd show this, and you've probably seen this in various guises in the past, and it just shows the importance of remaining invested, because ultimately there's always risks. There's always risks, and it's simply about how much return you're getting for that overall risk. But what this shows is the FTSE the FTSE All Share. So all the companies in the UK, and you can see that, and we plotted from the end of 1987, so start of end of 1987, and then we've simply shown what the performance would have been if you invest £100,000 in 1987. So it would have been around about £3 million if you invested the whole time. Just missing the top 10 days, so the 10 best days. So trying to time it, and clearly in volatile times, you might miss the downside, but you'll also miss some of the big upsides. But just missing the top 10 days kind of leaves you at, what's that, £1 million. So the difference is £2 million from missing the top 10 days, simply because if you miss those top 10 days, you've got less to compound in the future. So really, really important. It is about time in the market, not time in the market. Remaining invested is really important, particularly when risk is elevated, because that's when you get the big volatile up days and down days, which are really important to remain invested throughout. So as I say, 2024 was the year of the election. We do think 2025 is the year of the fat tails. That is both extreme downside and extreme upside. How do you navigate that? By being diversified, spreading your risk over different asset classes. But really importantly, when these fat tails come around, having the foresight to move into those different asset classes become really, really important. But expect the news to continue, expect extremes in markets, but ultimately staying diversified. I think we can remain robust throughout it all. My name is Onuekwusi. Thank you very much. Yes, go ahead.
Justin, thank you very much. Take a seat, please. So it's all about the year of the fat tails. All these words today I'm learning, and they've got completely different meaning to what you expect, but it's great to hear what you had to say. Thank you very much as well for actually explaining what it means for us now, because I suspect we'll get some questions to do with that. And it is time now, ladies and gentlemen, for our panel discussion. So can we welcome back, please, Ian Riggs, Gareth Davies, and Carla Bishop. You're going to join us on stage. You can take this away if you want, guys. We're doing a little bit of set changing around while we are introducing our speakers back on. But we'll get there. There we go. They had their Weetabix this morning, you can tell. And we'll get our other two chairs on. So I'll take a seat, and we'll come on stage, and we'll get the chairs with you as well. And this is your chance, ladies and gentlemen, please, to put your questions to our panel. If you can use the QR code, as we mentioned earlier on, good luck. And we'll get some of those questions, hopefully. And they will appear, we think, pretty soon on our screen. Okay. Here we go. There we go. That's fine as well, if you don't have to say who you are. But here we go. It says, thank you for today. Very interesting. I'm a guest with funds in HL. How easy is it to transfer to 8? And it says, thank you, Sarah. So I think that's from Sarah.
Sarah.
Okay.
Thank you, Sarah. I think we're going to make it as easy as possible is the answer. What you need to do is get in touch. So at the back of the brochure, there's a QR code. Scan the QR code, get in touch with us. And the process is straightforward. We will come and see you for a one-to-one financial advice meeting, and we'll have a discussion about what you need. And if, as part of that process, we think it's appropriate to transfer funds from Hargreaves Lansdown to anything we have to offer, we'll let you know. But I will add a caveat that often it isn't right. So we will take our time and do our due diligence to make sure that we don't make any bad calls in terms of transferring money or assets or products at the wrong time.
Okay. So it's doable, but you want to do it properly, is what you're saying?
Should I reinforce it a bit more?
Yes, please.
The answer is yes, is the answer, right? We can absolutely do it 100%. There's just, take some financial advice first.
Okay. We'll wait for some of the other questions to come in, but in the meantime, I wanted just if you could, I know you explained about where we should be investing, and a lot of what you said was great in terms of, made us realize about the need for having our financial advisors, because it is a minefield to navigate, isn't it?
It is.
But you were saying about smaller companies.
Yes.
So in terms of, for the people here today, what should they be asking their financial advisors then to look at, given what you said?
Well, clearly we're the investment engine for the financial advice business. So ultimately, by coming to us, you're going to get, you should get that asset allocation view, that house view, and that should be articulated to you in your meetings. We have a number of strategies which have small cap exposure, which the smaller companies fund is the key one, surprise, surprise. But ultimately as well, from an asset allocation perspective, we also have multi-asset strategies where we will do the asset allocation for you and allocate to those to those different asset classes. Really importantly, the house view does change. It changes slowly, but it does change. So ultimately, by having those regular conversations with your advisor, you will be taken on that journey as our views evolve over time. So smaller companies today, but in a year's time, 2 years' time, smaller companies hopefully have outperformed, and therefore we've taken that risk off the table and we've moved somewhere else.
Okay. I've got another one for you. In view of what's happening in the US, does SJP still believe in a higher allocation to US equities?
I think this is really important. It's a really important question. So, as I said, I mentioned about the top 10 companies in the US. What I didn't mention, which I probably should have mentioned, is the US as a proportion of global stocks now are around about 70% of 75% of global stock markets. They were 40% 10 years ago. So you've seen a massive increase in concentration risk from global stocks as well. So whilst we, from an absolute perspective, we do have an allocation to the US, around 50%, actually we are massively underweight when it comes to global market cap. So actually, the way we take that US view is we just have less than in global equity, global stock markets. So, as I say, we've got less UK equities than the average investor, but we still have a decent allocation to US equities overall. I think that's really important. And would we go lower? Yes, actually. You saw we were -1 on US equities. We can go to -2, and that would be bringing it down even lower. But we do think there is a risk emanating US equities at the moment, which is why we have a less than global markets at the moment.
Okay. Yep. If my advisor is planning to retire, at what point will I be introduced to a new advisor? Who would take that?
Yeah, I look at you two both looking at me. I'm not retiring. Is that what that look was for?
Not yet.
It's a great question. So I think we don't often know, and you who have ever made a retirement plan, that you're going to retire with certainty in 2026 or when I'm 60. And our advisors are the same. Yeah. So when we find out, which is the start of this, our job then becomes making sure that we find a suitable advisor to work alongside the retiring advisor, and if we can, for a period of time. So there's a soft handover. Often, if we can, through good communication, and if we can, with a joint meeting with the retiring advisor and the new advisor. So it's not, I think this is not a question of time, because the truth of the matter is we don't know, but certainly in the way we're going to handle it, and we talked about enhancing communications, we will be sure to let our clients know as soon as possible, and we'll do it slowly and seamlessly, unless, unfortunately, where there are events where there's sudden retirement through ill health or other reasons, in which case we're going to have to act swiftly and slightly less comfortable, I suspect. But we are looking out for that. It's a big challenge that the industry faces. As I said earlier on, the advice gap is growing, right? So we need to be mindful of this, and we are.
Okay. Carla, do you want to add anything to that?
I think from a communication perspective as well, we need to make sure that there are internal conversations happening with advisors when they are planning on retiring, but it's how we communicate that to you and how we introduce you to the new advisor. And I think that needs to be quite slow and steady, like Ian said, so that it's not conversations. We appreciate, a lot of people are very busy, so we want to make sure that those face-to-face conversations are happening, but you're kept up to date in the background at the same time.
Great, thank you. If I have an interest-only mortgage currently, will your mortgage monitor still be beneficial for me? Gareth, I think this is made for you.
One for me, I think. In a word, yes, absolutely. The repayment method of your current mortgage is largely irrelevant. It's the potential saving that can be made from the product that you are on now. The one big benefit also, if you're on the monitor and there isn't a saving to be made, obviously you'll know that, we'll know that, but equally we'll then be able to know when your current product is due to finish. Most products will finish at a certain time in the future, and we'll be able to open those lines of communication way in advance of that to make sure that if there's no saving to be made early, that we tackle it at the right time. So yeah, absolutely yes.
Okay.
Do you mind if I just add something on? So most of us who have got mortgages tend to be working. Those that are retired tend to be very strategic about how they're using their asset, right? So working people are busy. I have a mortgage. I completely forgot when my mortgage last renewed, and left it until I got a letter from my lender saying your rate is going from like 1.9 to 4%. And then I had 3 months of hot sweats and expensive interest. I'm now on this monitor, and I can genuinely assure you what you get is a periodic reminder, but then you get the offer, which is critical, which is, Ian, your mortgage is expiring in 3 months' time. The process is going to take 3 months. Let's have a meeting. Let's talk about what your needs are. And therefore, we're ready to transition from mortgage A to mortgage B. Gareth and his team being here, really, which we probably didn't get across, was to centralize the proposition, to try and make it a seamless, all clients have the same experience proposition, and that's the experience that we want. You don't miss the trick. You don't pay a lender 2% extra than what you need to, unnecessarily so, because we're on it, using a great piece of technology.
Great, thank you very much. We've got one listening from home. What qualifications will a successful candidate for your academy have? I'm guessing is the end of that.
Yeah, hi Lees, by the way. Hope you're well. We are 100% focused on people, okay? So it's not about what qualification somebody's got. It's about the person. Do they have the right attitude? Are they go-getters? Are they positive thinkers? Will they work in a team? Are they going to work hard? Because, frankly, what their qualifications are largely irrelevant, because we're going to teach them everything. But the one thing we can't teach anybody is attitude. So a positive attitude and a great mindset, bring it to 8. That's what we are all about. And our academy, and somebody asked me this at the break, our academy is always open. So it's not like we're recruiting for 2 months of the year to get a cohort. It's open all the time. And we had a conversation last week, didn't we, about the diversity of our academy. And just let me test the audience, right? If someone asked you to draw a picture of a financial advisor, what would they look like?
I think
right? You're all laughing because they would look like me, right?
Like
You're absolutely right. A 50-year-old white man, right? That's the reality of this industry, right? And we need to change what we're finding, because at the moment we're finding 25 or 30-year-olds white men. Yeah, and actually, we're going to unbundle our recruitment process and find out what is it that we're saying that's not attracting a much more broader demographic of people, because it needs it. Our catchment needs to be widened up. So anybody, with a great attitude is perfect. And we've got many of our advisors in here, and they have varying levels of qualifications, let me tell you. Former people that worked in banks, people that used to be bakers, someone that used to be the top seller in the country for Ann Summers, right? We've got it all, right? But the truth is what makes them different is their attitude.
Yeah.
I think we want to meet that advisor now, the one you just mentioned. But
he doesn't do it anymore, apparently.
Sounds great. Okay, this is for you, Justin. Are you suggesting de-risking a Polaris 4 portfolio to achieve a more diverse portfolio, re-asset classes? And the second question, what is SJP doing in Polaris 3 and 4 to reduce US equity allocation? I haven't got a clue what that means. I completely...
Lucky, I do.
You do.
No, so from a de-risking perspective, when it comes to Polaris 4, what we're looking at is where are there cheap hedges, so to speak, against some of the political noise that we're seeing. So it might be, for example, that if we have a small allocation to bonds, or we may have a small increase or add a small allocation to bonds in Polaris 4, but they'll be inflation protected, because ultimately we think that there is a risk here that inflation does spike, and therefore, from a bond perspective, you want to have more inflation linked rather than non-inflation linked. From an equity perspective, and Polaris 4 is pretty much 100% equities, we're looking at, taking more smaller cap exposure, as I mentioned. Actually, we're taking more UK exposure as well, because UK looks, again, really cheap. They're global stocks rather than UK stocks. 80% of the revenue is driven from overseas. So adding that to the equity allocation, we think makes a lot of sense. There are other areas in the global stock market which look particularly attractive. So Japanese mid-caps is a really strong one. Japanese mid-caps are completely unloved by the market, yet you are seeing corporate change in Japan, which is meaning that you're seeing global investors start to come back to the Japanese market. So these are all the things we're thinking about within Polaris 4. And then within Polaris 3 and 4, what we're doing to reduce US equities, actually, as I say, the equity allocation in Polaris 3 and 4 is way below global market cap. We're nowhere near the 75% that you see from global markets. We're down towards the 55% level. So we've got actually a sizable underweight relative to US large caps. And where we are taking more US exposure and we're more positive is in the small cap area, which tends to be, again, that's around about 50% in US smaller companies. So hopefully that gives you kind of a tour of kind of where we are in terms of asset allocation.
Okay, thank you. This has come from Paul. Many of us with pensions that are now going to be subject to IHT are concerned of the best things to do. I know the legislation has not been finalised, but what should we be advised to do?
I could talk about this for hours, right? So my team will know that I have, got lots of opinions about Rachel and her, I'm going to tax your pension fund when you die strategy. So I'll keep this as short as I possibly can, right? If Rachel is still here, big gigantic question mark, right? And we don't have a chancellor that decides to do something different, big question mark. And if inheritance tax is introduced on someone's death on their pension fund, the first thing to do is don't die, right? It's a really, really important part of the process, right? Don't die, stay fit, stay healthy, right? Second thing to bear in mind is interspousal exemption applies. That's been made very, very clear. So if you are married, it's the youngest and most fittest one that we'd be saying don't die, right? Because the first one dies, it passes IHT free, so you're all good. And the reality is if it comes in, it's only going to be taxed when you do die. Yeah, your normal life expectancy, if you are in the 55 plus bracket, is 88 to 92 years old. Yeah, the chances of you dying whilst there is a government run by the current Labour Party with Rachel Reeve and a chancellor being around when you're 88 years old with inheritance tax on your pension is quite small. So our advice is do nothing different, yeah? Spend your money, have a good plan, and if you weren't spending enough, spend more, yeah?
Okay, great. So don't die and spend more. We like that. Okay. This is a nice one. It's if I'm just starting to invest, what's the most important first step to ensure a strong foundation?
Shall I go with that?
Yeah.
Yeah. So I think the key foundation for me is to diversify and spread your risk over different asset classes. Importantly, investing isn't about gambling. And you saw the patchwork quilt where you saw some asset class had done really well and so on and so forth. Actually, the best thing to do is to be in the middle of that patchwork quilt, grinding out returns year after year after year, remain invested. And the last thing, and this is really important, is the one thing that detracts from long-term returns tends to be investor behavior. Investors taking money out of markets, and when things become more volatile, or de-risking portfolios significantly at a time when risk becomes elevated, because ultimately you have to take risk to get return. So really importantly is understanding your emotions and your behavior, and being disciplined to remain in the markets, keep to your investment strategy, and as I say, being diversified. They call it the only free lunch in investing, because it ultimately gives you a smoother return stream over time.
Great, thank you. And I'm just checking how we're doing for time, because I think this may well be one of our last ones, but it's from John, and it's John says, how does 8 benchmark its performance against its competitors?
It's a great question. I think if I assume it's investment performance,
Yeah, I can take
you can take it.
Yeah, I can take that.
But I'll also assume it might not be, so I'll take it.
Okay.
Should we 50-50?
Yeah,
Okay.
sounds good.
Heads or tails?
Tails.
Yeah, you win. You're first.
Okay, so I'm actually really proud of and obviously I oversee the investment performance. In 2024, 83% of our strategies outperformed the peers. So if you look at each individual fund that we have, 83% have outperformed the peer groups. When you think about our multi-asset funds, so Polaris, the average outperformance, and that's our flagship strategy with all our best ideas and so on and so forth. If you look at those Polaris strategies, you got an average outperformance of the average competitor of over 2%. So significant outperformance versus the competitors overall. So actually, and then over 5 years, 75% of our individual strategies again have outperformed the competitors. So hopefully that gives an answer to that we are, that relative to competitors, I look at it all the time, I'm obsessed about it, that we are delivering strong returns across the board.
Okay.
Yeah, and ours is very simple. We are full of and members of peer groups in the industry, so industry peer groups, both inside and outside of SJP, sharing best practice, listening to what other people are doing, taking the best bits, not telling them our best kept secrets. That's the first thing that we do. And the second thing we do is market research. So we ask the people that aren't our clients, what are you getting, what are you receiving, what do you expect? And we kind of use those as our main benchmarks of how, as in a financial advice company rather than an investment management company, our service offering and our proposition compared to most. We are a massively changed mindset. Carla mentioned it earlier on. We are not afraid of making improvements. We want our clients to tell us what they think, positive or negative, because we want to continually improve and be the best benchmark that everyone else can aim to achieve, basically.
Great, thank you. I know we were told we had 5 minutes, so I think we've got 3 minutes now. Okay, so this is the very last question, and it is for you, Justin. With a lot of companies and governments pulling away from net zero, how is SJP remaining committed to their climate goals and objectives as a sustainable business for the future?
So we have a net zero target. We're on track to meet that. We've got a number of strategies within our range which are focused on this area. So the sustainable responsible equity strategy is one of the largest. In fact, it is the largest sustainable strategy in the industry, equity strategy in the industry, managed by Schroders. We're also looking to develop a multi-asset strategy as well, which focuses on sustainability. I think one thing that's really important, and as we spoke about technology before, as technology becomes more usable, I do think more and more we're going to think about how values-based investing means different things to different people, and it's not necessarily for me or my team to say these should be your values. So I do think over time, as things become more nuanced, portfolios will become more individualized and so on and so forth. And this is one big belief, one strong belief I have over the next kind of 5 to 10 years. That's the way the market will evolve. But ultimately, we have a number of strategies which are helping us meet our net zero goals, and we want to develop more.
Great, so you're not pulling away is what
No.
you're saying. Brilliant, thank you very much. 2 minutes. So do you want us to take this last question? Yes, okay, right. Final question then, she says for the third time. How do all these services, mortgages, investments, pensions and protection, tie together in a single plan?
It's called Voyant. I talked about it earlier on. The purpose of that system is to take a client's entire financial world, pull it into a system, and then sit down and model and play out their scenario with their plans. It has, what I call magic buttons, in it, which, it can answer questions like, how much do I need to protect myself against my early demise? How much do I need my mortgage interest rate to seal at so that I can afford to save for my retirement? It's Voyant. It's going to revolutionize your meetings and your financial world, I promise you.
Okay, is that available straight away then?
It is available.
Okay.
It is available, it's live, it's available for clients to use. We would love to sit down and spend as much time as possible working with all of our clients on Voyant, absolutely.
Great. Okay, we will leave it there. Ladies and gentlemen, please thank our panelists, Justin, Ian, Carla and Gareth. And thank you all for joining us for the Q&A today. Thank you.
Thank you.
Thank you.
Thank you. Now, I know it's very nearly lunchtime, but before we actually do break for lunch, we're going to hear from Victoria Riggs from 8 Foundation, which is our charity, and she's going to tell us more about the fabulous work that the charity does, or the foundation does, I should say, and how we can all make a difference. Please welcome Victoria. Hi, Victoria. Hello.
My mic, oh, it's working. Hi, everyone. So what a pleasure it is today to see you all here, some old faces, some new faces, and I'm just going to quickly reintroduce and remind about our wonderful 8 Foundation here at 8. I haven't got a clicker. Okay, thank you. Okie doke. So, vision, very clear. You can all see that, but the main word that we kind of want to get out of this vision is growth. That's what our vision is moving forward. We want to grow. We want to be bigger. We want to be better. We want to help more, and we want to give more away. And that's where we need your help, actually. So I'm just going to take you through to what's happening in the first quarter of 2025 so far. So you can see some lovely, wonderful pictures of some of the new grantees that we've got coming up. I'm not going to go into too much details about them because A, I haven't got the time, and B, we want to wait and share when we've met them all, and it's a big story, which is why we're going to encourage you later on to follow us, keep up to date, so we can really share with you the magic of the foundation. You'll see a number at the bottom there, 32,058p. That is what we have just committed to be given away to local causes within our community in the first quarter of 2025, which is amazing, exciting, and something we can't do without the support of all of you here and everyone within our community. So thank you. So why? Why do we do what we do? Why have we got the 8 Foundation? Why was it started? Why? It's easy for me to say why, because we care. We've got 8 is all about community. The foundation really sits at the heart of the culture at 8, the community at 8, and actually every single person sat on a chair today is part of our community. You're with us, you're our clients, our staff, our advisors, everybody is all part of the 8 community. That's why we do it. We want to change lives. We want to be a responsible business. We want to make a difference. And that's exactly why we've got the 8 Foundation. Something we're incredibly proud of. I hope you're proud of. And I hope that, you want to get involved as much as we all would want you to. So here's some wonderful pictures of some of the people that we've helped, and our amazing mascot, Super 8. He's wonderful. You'll see, I only got a few minutes, so I'm just going to go quickly to the lady on the left over there, Christine. So Christine was a young lady that we met, lived locally near our head office in Whiteley. Christine had, she's got multiple health conditions, multiple struggles. We met her, and she's not shy to say she was in an extremely dark place. She couldn't see forward, she couldn't see anything. She was just, I don't know what to do. An incredibly talented lady. So we were privileged to be put in touch with her. We've given her support. We've purchased new equipment so she can become independent, so she doesn't have to rely on her kids being carers for her, which has now evolved in her re-loving her passion for archery and is currently training to hopefully join the Paralympics team for Team GB. So amazing. So a real testament to the S8 Foundation and what changing lives actually means. I need to breathe. great. So you'll see here, this little boy here is Theo. Theo today is why I brought Theo with me on the screen to really understand the question of why. Why do we do it? Theo is why we do it, and Theo is why we want to continue trying to change as many lives as we possibly can with your support. So Theo is a little boy. He is 6 now, I believe. We were put in touch with him around about a year ago. So even though I can't breathe, because I hate talking publicly, we are all able to stand up today and deliver a message to you. You've all said good morning, we've all greeted each other, all the speakers have got up today, they've done Q&As, they've done it, and actually, I think every single one of us has probably taken that for granted, naturally, not by fault, nothing, just naturally, because that's what we do. Theo, when we met him a year ago, was completely non-verbal. He struggled to communicate, he struggled to tell his mum and dad, what you want for breakfast, simple things that we do take for granted, So we were put in touch with Theo, and, that he was receiving some speech therapy in schools, but as you know, it's tough, and the education can only provide so much, and it's not always enough. So we thought, I know what we can do here, we can do something for Theo. So for the last year, we've been supplying private speech therapy for Theo. And we're a year on, and this little boy is communicating with his peers, he's communicating with his family, he's able to tell us what he wants for lunch, how his day's been at school, his education's improved, and he is, I said Christine was a testament, but I think Theo is too, as to we've found Theo, and we've completely changed his life around, and Theo's just got something he wants to tell you himself.
Thank you for your book expansion. It helped rise it and me happy everyone can understand me.
Give a good wave.
How beautiful is that? How amazing is that? And, we want to find more people like Theo. We want to find it. So you'll find me at the back today. I want to know about if there's anybody you can help, anybody if you want to be involved, you want to be a volunteer, everything. We want to know about it. We want to really engage you guys back into the foundation, what it stands for, and really be actively be part of it as much as you want to. So what does 2025 look like for the foundation? Well, we're growing, and we're welcoming Lauren, a new member of staff, in the next couple of weeks, which is super exciting. She's been appointed as our fundraising and community engagement champion. So her role is really to get out there, help us grow, find more people, find more supporters, and she's super excited, and we're super excited to have her. Like I mentioned before, when we were talking about Theo, it's building that better connection with, our whole community, you guys, our supporters, and really getting you involved and building that kind of base of where we can tap into and how we might be able to help you. Because I think here at 8, we've heard all today how we're here and we can help you on your financial journey, but we can also help you and care for the people that you care about. So we want to know about that and see if we can do anything to support. And it wouldn't be a chat if I didn't talk about our annual events this year. So every year the foundation do little events throughout the year, bits and bobs, which is why I encourage anybody, if they want to know more, to come and sign up down at the desk down there and just, scan the QR code, sign up to the foundation, where you can find out a little bit more about what's going on, all the new stories that come out, and you could also be in the chance to win a luxury hamper, which is always a bonus. So every year we hold a golf day. And that's on Friday the 12th of September at Barton-on-Sea. And we also held our annual charity ball, which this year is being held at the Hilton Utilita in Southampton on Saturday the 15th of November. So if you are interested, please do come and see me. We'd love to see you there. It's always a great night. And then follow us. So we just want you on the journey with us. It's such a wonderful thing to have the foundation, and it just wouldn't be the same if you weren't all there with us. So please do get involved. Follow us on social media. Come and speak to me in a minute. Any questions, I'm more than happy to answer. But thank you very much for your time, and hope to chat to you all soon. Oh, I forgot. I forgot. I did my classic. I did every single time I prematurely say goodbye. More importantly, we've got this. So some people have been coming to ask me about this today. So we have got the sign up to follow us, find out a little bit more about us, get engaged. But we've also got the opportunity where you can be part of helping us raise some funds today for the foundation. We've got a £200 theatre voucher with dinner and wine for two up for grabs. So if you come and pop down at the table down there, and you can enter there, and we'll hopefully find a winner today. So thank you so much for your support. Thank you. Going now.
Thank you. Victoria, thank you very much. That brings the formal part of today's event to a close. Hopefully you enjoyed hearing from the speakers, ladies and gentlemen. Yes? They've been great, haven't they? So let's thank them all once again. Thank you very much. Thank you as well for being such a great audience today. That is it from me as well. I wish you continued success and even greater wealth. And I'm now going to hand you back to Ian to formally close. So from me, thank you, and have a great rest of the day. Thank you.
Just got a few closing things to say. So first of all, let's have a huge thank you to our amazing host, keeping us all on track and asking us the tough questions. Thank you so much. Thank you to everybody for coming. We've got a great little afternoon planned for you, which I'll come on to in a minute. This event doesn't happen easy. There's been a lot of time, a lot of effort, and a lot of dedication. You know, we were... well, I say we, I wasn't actually here, but the team were here last night mopping the floors because this is normally full of dust and wood chipping. So huge round of applause to our amazing marketing and events team for putting on a fabulous day. Thank you. Don't forget there's QR codes at the back of the brochure, and if you're watching this either online or you're watching a recording, there should be a QR code coming up on the screen now. I'm hoping it's this side. Feedback's really important. It's how we learn, we add more value, and we give you some great things back. So please give us your feedback. Now, for those in the room, I've got a little gift for you. Courtesy of our event sponsors, under random chairs, there are some little gifts for the lucky people sat under the random chair. So dive under the chair. Underneath the chair is some random prizes. If they're spare chairs, yeah, then fill your boots. Go and find the vouchers under the spare chairs. I think they're stuck underneath. Is that right, team? Yes, underneath. They are stuck underneath your chair. Look how keen this lot are for free bits and pieces. Do we have any winners? All right, we'll check all the like people are lifting up chairs. This is amazing. We'll check that in. I promise you there are definitely some lucky people. If there's not, come and see me. Otherwise, I've just made a fool of myself. So what's going to happen next? So at the back, we've got some lunch. So we'd love you to come and join us for some lunch. We've also got 3 stations. So we have our tax and accountancy business manned by 2 of our team who are happy to answer any questions you've got in relation to some tax. We've got some of our financial advisors, and then we have the foundation. So any questions about any of those matters, please go and talk to the team. Have a great lunch. If you want to stay beyond lunch, there'll be a gentleman or a lady from the museum who's going to do a short talk and then take you on a guided tour. If you don't want to go on the guided tour, this place is yours to explore. Have a fantastic day, and thanks very much for your time. Appreciate it.
Thank you.